Good morning, everyone. My name is Cynthia Mbaru. I work in the corporate finance team at Dyer and Blair.
Good morning, everyone. My name is Joseph Rono. I work for CPF Group as the Senior Group Executive Director.
Morning, everyone. I'm Mary Njuguna, and I'm a Principal Specialist with the FSDA Africa. That stands for Financial Sector Deepening Africa.
Good morning, everybody. My name is Shadrack Mella from JLL, and I oversee valuation advisory in Sub-Saharan Africa. Thank you.
All right, thank you. So in this session, we're going to delve into emerging trends and innovative asset classes, including commercial, residential, industrial, and specialty sectors like data centers and healthcare facilities. So in terms of the first question, this is addressed to Shadrack, and then Joseph will ask you to answer. What are the most promising asset classes in the African real estate market today, and what is driving the interest in these classes?
Thanks, Cynthia. So, I mean, it's always an interesting question because I think in conferences all the time you're usually discussing pretty much the same topic. But I think I would say it's a mixed bag. Africa, totally different markets. We always tend to speak about Africa sometimes like it's, one homogeneous market, but it's not. But if you think about it, it's a very mixed bag. I mean, in some cases, you can argue that Africa is a country because there are sort of themes that cut across the board. But if you think about the traditional retail and office, for instance, post-COVID, those went through some changes, and those changes have, sustained over time. With retail, there's a lot of challenges that shopping centers are dealing with, especially when it comes to, the issue with hard currency leases, for instance. I think I've seen that as a very prominent challenge in most of the prominent shopping centers across the continent, just by virtue of the fact that the currency challenges that a lot of African countries have faced have meant that sustaining dollar rents, which a lot of investors, institutions prefer, has become a challenge. So with retail then, you can argue that it's not very promising from that angle. And a lot of institutions, if you look at REITs in South Africa, for instance, they've been shying away from retail. But at the same time, you still have institutions that then, that's their specialty, and that's what they want to get into. So a recent example is Lango, for instance, which is a fund that was started by Growth Point in South Africa. And they've recently made an acquisition of, the reported value is close to $200 million, but I don't know if that's the case. We have our friends here from GCB in Ghana, because they've bought 3 shopping centers in Ghana and a shopping center in Nigeria. Ikeja, Accra Mall, which is probably the best shopping center in Ghana. They've acquired that. So you see, at the same time, while you might argue that retail has its challenges, you still have investors who, it's a specialty. They'll narrow down on specific markets they want to target and keep growing the fund. So that's a fund that's close to $1 billion now in AUM, and it's primarily office, retail, and a bit of logistics. So I don't know if we have enough time to sort of delve on an asset level category, but with office, the challenges persist at the same time. Hybrid working has really affected the office sector, but at the same time, the best office properties in the primary markets on the continent, well-designed, green building credentials, strong covenants, they tend to perform well. So if you think about sort of those two as the traditional real estate asset classes, I'd say yes, they're not very attractive, but they're still pockets of opportunity. Even in Nairobi today, you could argue that there's probably no room for a huge regional or super regional shopping center. But you'll look at some locations and you'll find that, convenience retail is tending to reach sort of a level where it's probably getting saturated as well. But there are still pockets of opportunity within the city for, neighborhood, community shopping centers. So if I sort of touch on what I see as an area that cuts across the board, and there's opportunity really across most African countries or jurisdictions, it has to be affordable housing because of just the demographic dividend that most African countries have. Young populations, an underserved housing market, and really a supply-demand mismatch in favor of more demand. Of course, the challenge with delivering that then is the usual things we, again, talk about in all these conferences: high land prices, high increased construction costs since post-COVID, and they just keep going up, high finance costs, currency problems. Our friends from Nigeria, Ghana will tell us about currency problems. And yeah, so there's really, it's a mixed bag, but I think with housing, affordable housing, it's continuous work to try and sort of crack that. But I think there's lots of opportunity there. The others are very specialist in nature. Of course, we can speak about data centers, but yeah, again, very specialist. Not everybody will touch that. Healthcare, we've seen, for instance, a model with the Falcon Group from India and GRIT in Mauritius, where that is really picking up. Again, a very specialist asset class, but it presents opportunities. And if you think about the healthcare sector in Africa, it's a sector that's not been fully tapped, so lots of opportunities there. Logistics has been very resilient post-COVID. For the obvious reasons we've discussed before again. And if you look at institutionalized markets like South Africa, logistics focused REITs have actually performed very well over the past 4 or 5 years. Yeah.
Thank you.
So perhaps further to what Shadrack has touched on, there's a new move, not necessarily merging, but it's coming out very strongly on the real estate sector. And this is touching on infrastructure around student accommodation. And not just housing for students, but also facilities around education institutions. For example, you'll find there are a lot of international institutions which wants to set up, want to go into that space in this market. They don't want to go into real estate. So in most cases, they'll be looking for a partner whom they can join together for purpose of operating the business, while the local partner then owns the real estate. And that's a typical example which we found a very good success story within CPF and Lab Trust Group, where we partnered with an international school, where we developed for them school infrastructure, and over a very good tenure of lease, close to 30 years, which really gives us stability in terms of continued flow of that income. So of course, student accommodation, I think, is the space which Econ has been doing a lot. And you can imagine the dynamics within the African continent. There's the increase in terms of population. And when you look at the facilities, we've had underinvestment of facilities over a very long period of time. So there's a huge demand for that particular space. I think Shadrack has spoken about affordable housing. And affordable housing in the sense that if you look at many of the housing units which has traditionally been provided into the market, they are not within the affordable space, or basically affordable to the extent of the middle class. So with the coming in of these units, there is a huge opportunity there. I think he's spoken about retail. Let me not labor so much on that. I think the biggest opportunity around the retail space may not necessarily be within cities, but what we'll typically call highway malls. We've seen the one which was, I think, developed here in Naivasha. The space was snapped up within a very short period of time. As you drive from Nairobi all the way to Nakuru, you find the mall is very vibrant from morning to evening. Yeah, thank you.
Thank you. So the second question we'll direct it to Mary. Have you encountered investors who have cross-border real estate strategies? What challenges are they facing, and how are they mitigating this? And then what can governments and policymakers do to create a more conducive environment?
Thank you, Cynthia, for that question. So for us, from where we sit, because we work across the continent supporting capital market development in local currency, in terms of local currency issuances of innovative instruments like REITs. So I think we see, and we have many discussions in terms of pipeline opportunities that we see in various markets, Kenya included, and some other markets that are represented here. So I think what is interesting is there's a lot of interest, but I think it's good to categorize the investors into different categories. Of course, we have retail investors, institutional, and when we talk about institutional, we can categorize that differently in terms of pension funds. We also speak to development banks, sovereign wealth funds, and also impact funds, or funds that have an impact objective. And so all these investors have a different incentive, I can call it that. And so what we see is that investors are, let me talk about pension funds, for example. I think I like to say that what we see from pension funds in different parts, even of the continent, is quite different. We are finding that in some markets, actually, and not Kenya, unfortunately, but in some markets, we're finding that some of the pension fund managers are actually thinking to consider other options, other investment options. And so even at the moment for us, trying to help them to, get over that hurdle also requires regulatory changes that they need in their regulatory frameworks to enhance investment thresholds to enable them to invest a bit more outside their boundaries. And so that's interesting, and I think that's driven by their own unique situation. In some instances in the country, some of the countries we've mentioned, they've actually struggled because of the holdings that they had in government securities, being impacted by the debt restructuring situations. And therefore we find some of those fund managers are very open to investing cross-border. So those are pension funds. But let me talk about impact funds as well. So we find that funds that, or investors that have a sustainability focus are interested in investing beyond borders in various different markets, because sometimes they have a large mandate in terms of ticket size, so may not be able to get enough appetite in one jurisdiction. But the challenges are many. Let me maybe segue into that. And I think the earlier panel discussion highlighted several of those, whether it is FX challenges. That's very difficult for an investor with a cross-border strategy. Even when you talk about interest rate environments, when you're talking about institutional pension funds, there's a disincentive sometimes to invest in a different asset class if the competing asset class has quite a high interest rate that is attractive to pension fund managers. But I think, on the regulatory side, I'm sure in this room there'll be a lot of discussion around that, and it was mentioned in the earlier discussion, whether it is around legal certainty, which is very important. In some markets, it's not very clear when you talk about tax, the tax situation or tax treatment. We talked, earlier it was mentioned that stamp duty, for example, in Kenya is not, has not been removed to facilitate tax neutrality. But I imagine, what we see for institutional investors that are operating across markets is that they need to deploy sometimes expensive risk mitigating solutions like FX hedging solutions, which can be expensive. So, the long and short of it is that yes, there is some level of interest. I think a lot needs to continue to be done on the policy environment, regulatory environment, but also on the macro environment to just make it more attractive for them. I think the last one I wanted to say is when we are talking about affordable housing as one of the potential asset classes, I think just enhancing the availability of data that helps investors that have a cross-border mandate to be able to compare and make informed decisions based on evidence. Yeah, thanks.
Maybe if I could just add something onto what she said, Cynthia. So with the issue around effects, it's a real one, and I'll speak of maybe two more challenges. The first one is on return expectations. So there's always this sort of tendency to say that there's not enough capital, maybe looking for property to invest in sub-Saharan Africa, outside of some markets like South Africa, which are very mature. Okay, but increasingly, what we keep seeing from where we sit is that the problem is really the fact that we have a market that is not institutionalized, and the primary owners of property are individuals and families and whatnot, and return expectations are just sort of they don't make sense. So the earlier panel spoke of T-bond rates, a 10-year government bond of Kenya. It's coming down, but maybe it's 14%. So the sort of trophy assets across the main asset classes in Nairobi, if you speak to some of the owners, they want to sell those assets at what, 7-8% yields or cap rates. There's no way investors are sort of going for that kind of return. So it's a problem of sellers who are really not motivated to sell. It's not that there are no offers on these properties, but return expectations are very low in the sense that they want to sell the properties at very high levels, and so deals are not happening. So the biggest barrier to deal making in a couple of the primary African markets that I've seen, like Kenya, Ghana, Nigeria, is really just owners who have return expectations that are not in line with investor expectations, and that is a huge hindrance to deals. The FX problem is a real one as well, and recent examples I've experienced or dealt with are Nigeria and Ethiopia. Investors have a significant problem repatriating funds. I mean, the FX dollar problem in these countries is such a huge problem that there's a lot of money, for instance, property owners have stuck in some of these jurisdictions that they can't get out. So what happens is it sort of reinforces that feeling or perception that the risk and the FX risk and everything else in Africa is so problematic. And then the same investors really want dollar returns on these assets, as a risk mitigation measure. But it's difficult to underwrite those dollar leases going forward unless it's multinationals that have, a broad sort of revenue stream and receive revenues in dollars as well. So the currency issue is a big problem, and I think increasingly going forward, investors will have to contend with local currency rentals and find other ways of sort of managing risk and return expectations. Yeah.
Thank you very much. So our next question is, and we'll ask Joseph to start. When we think of real estate, we tend to think of brick and mortar. So how does technology fit into the real estate landscape? And do you have a couple of examples of adoption of technology in the sector?
Thank you, Cynthia. Technology is actually becoming a very important enabler in terms of any investment, and more so real estate. Nowadays, you can hardly have a successful real estate project without embedding some element of technology in it. So let me just mention one, which is on things to do with the virtual tours. Sometimes you find, especially our guys in diaspora, they'll want to make decisions on even what properties to buy, and many of them will not necessarily need to travel all the way to their countries, for example, for them to make a decision. So when you have what we call visualization of your development in terms of the general outlook, you are then able to enable some of those investors to make a decision, an investment decision, without necessarily visiting. There are things to do with the IoT devices, the Internet of Things. It's become very common. I think these are the devices which are powering applications like air, bed and breakfast. There are countries you visit where you literally don't meet anybody. You book for your space while abroad. You pay for it. You're given a code to access the unit. You go into that country. You do your business for several days which you've booked, and you basically return back without necessarily meeting anybody. So that's a typical case where IoT devices are powering real estate. The other very interesting thing, which personally I even have personal experience, is IoT devices to deal with management services. You find sometimes you could be having, for example, maybe things like normal things like pumps which are operating in a premises, for example. So you'll find that there are IoT devices in this market whereby, assuming, for example, you've solarized your premises, for example, the power cost, of course, is a bit expensive. So you want to take advantage when the solar is working during the day. So you then want to channel most of your resources to take advantage of the solar power during the day. So there are IoT devices in this market which you can actually make a decision on when to run them on your phone. Like, for example, while seated here, you can switch on a pump and or put it on automated mode, which runs perhaps from a specific time during the day and switches off at some point during the day when the solar power is still very, very intensive. Of course, there are now emerging issues. We're happy to see government also adopting technology on issues to do with land registration, for example. I'll tell you something like Athisasa has been a major transformation in this market. I don't know whether some of you have transacted on land, especially in Nairobi, through Athisasa platform. Those days when people will con you that they own the property when they are not, is really gone. Nowadays, if you are buying any property, for example, in Nairobi, one of the first conditions you tell the buyer is that the property has to be registered in Athisasa. And then the process of conveyancing, of course, through the lawyer, through the system. So it has more or less become like a cash transaction where as the title passes ownership from one person to another, you then facilitate transfer of funds. So I think these are some of the technologies which have really made it made the real estate, first of all, very reliable. Is an investment which now people can trust to put their money in. Yeah.
Great, thank you so much. And then our last question, and we'll start with Mary, is how are investors or developers incorporating sustainability as part of their investment thesis?
Okay, thanks, Cynthia. Just going back to what I said earlier about different types of investors. At least one of the things we see is there are investors who have an impact mandate, and there are pools of capital that are looking for that kind of, those kind of properties that meet their impact objectives. So I think just to say that, of course, one of the things that, developers would do is make sure that the buildings are green, they are GRESB certified or IFC Edge certified. And I think that has very many benefits, not just in terms of the investor, but even in terms of not just in terms of attracting a particular kind of investor, but also in terms of performance, not just in terms of waste or energy conservation, but also in terms of how well those properties do in terms of, they have lower vacancy ratios. But also, there are certain types of certain types of tenants who are looking for that kind of property. If you're looking at maybe multinationals, I'm using, for example, Nairobi as an example, and I'm sure it happens in other markets. There are a certain class of tenants that will not take less than grade A properties that meet certain sustainability requirements. So that already pushes a certain type of quality of building with certain metrics around ESG, for example, and that attracts those kind of investors. It means also that there is a lower vacancy ratio compared to others. So that becomes attractive on the whole for various investors. So I think that's one of the examples that I would give.
Great, thank you. Joseph, maybe you can comment in terms of sustainability and the Lab Trust in Maracha.
Yes. We have a good experience in terms of sustainability, and when you look at sustainability, you look at it three ways: environmental, social, and economic. So the three facets has to be, you got to look at them in terms of how do you then make some of these projects very sustainable. So one of the things which we've adopted, for example, as Lab Trust, and especially property sitting in our rates, we've embedded the aspect of EDGE certification, which is an IFC certification procedure of really making sure that the buildings are very sustainable. So one of the things which we've done is on issues of power, we have solarized all our buildings. So during the day, a significant portion of power is called from solar and a bit, of course, from the grid. And then one of the most interesting sustainability issues around water is a project which we did in Langata. I think for many of you who knows Nairobi very well, Nairobi is heavily constrained with water. There's a serious shortage, especially around that ecosystem. So when we looked at that particular complex during the conceptualizing stage, we realized the water yield from both the borehole and the Nairobi water was not enough to sustain the complex. So what we then did was to put in a water reticulation plant, which then recycles water from that particular complex for reuse on things to do with flushing of toilets, issues of gardening, which has really made the project very, very sustainable. On issues of, I think I've already spoken about issues of water, and then of course the aspect of making sure that there is use of renewable materials. I've seen that one a lot of excavation from the site. If you look at many projects run by especially people like Chinese, you'll find them reusing the materials either out of excavation for purpose of making sure that you are not creating a big hole elsewhere while you are doing a project. And then of course above that, issues of lighting. We've seen designs of most buildings going towards ensuring natural aeration so that you cut down on mechanical ventilation. We've seen a design of buildings with large windows so that you are able to use natural lighting. And then of course issues of even use of water efficiency in terms of, for example, flushing toilets. You have these very efficient systems which is able to take care of that. Thank you.
Thank you so much. Maybe Shadrack, any comments in terms of sustainability?
Well, I mean, I think they've spoken well around what's happening in buildings and ESG and sustainability. What I can just add is that it's good that we are now getting practical examples of the output of some of these sustainable practices in buildings, because I think a couple of years ago it was sounding like more just a conversation around, well, it's like a nice to have, but what are the real benefits around it? And from what I've seen from sort of the perspective of investors is that obviously in mature markets, for instance, there's an element of brown discounts and green premiums. So brown discounts means investors are pricing down older buildings just because of the fact that they have high ESG risk, high risk of obsolescence, higher lifestyle running costs and whatnot. So they would want to sort of, price it down because you have to account for the fact that in future, I have to set aside cash to retrofit the whole building, right? While with greener buildings that are, more efficient, they're saving costs, they're earning a higher rent per square meter just because occupiers prefer them, investors are willing to pay a premium for them. So they're willing to accept a lower return just because there's a lower cost to owning this building over a certain period of time, and it makes more sense. So this is not happening. I don't think we've seen evidence of that in, let me not speak about the whole of Africa, but in the Kenyan context. There could be examples in South Africa and Mauritius, but it's something that is going to catch up and it's coming. I mean, it's only a matter of time. Yeah, I think that's what I can add on the sustainability conversation.
Great, thank you so much. We wanted to open it up to the audience. If you have one or two questions for the panel.
Come on, of course you do. Of course you do. And I'm coming to the back of the room as well. You didn't even get to the Vuvuzela time limit. Well done. All right, back of the room. Where's the free microphone? Fred, I'm going to borrow yours. Anton, if I don't come to the back of the room, I'm coming to you. Knight Frank? Or you're just sitting in the back, chilling? Easy. They have an office on Wacky Way. They don't need to hustle at the front. Anton, do we have a question? By the way, I'm coming to you ladies just now. If you're scared to answer any questions, I'm queen of dumb questions. So, Anton, you're up.
Thanks, Davina. Anton Bolkum from Rebel Group. To the panel, given the complexity of cross-border investing, do you not think that denomination of REITs in an international but neutral currency such as US dollars would bring a huge amount of liquidity into this market?
So starting with an easy one, who wants to take that?
Shadrack, do you want to try?
Yeah, let me try. I think I'll go back to the point I made earlier around just the challenges with denominating some of these leases. Forget even at the REIT level, but even at a property level in dollars. You can speak to some of the people here from the REITs. There's people from ILAM. Okay, Aircon is a local student housing REIT, so that's not an issue. But I mean, it's easy to do that on paper, I would say. I think the challenge would come with trying to implement and execute. If you speak to a lot of, retail and shopping center and office building owners in Nairobi, I think it was easier to do that a couple of years ago. With what's happening with the Kenya shilling, picture the Kenya shilling depreciating, say, 10%, and tenants have 5% dollar escalations. In a year, and this is an entity that's selling locally only, in a year that's a 15% rental increase in local currency. So it becomes very difficult to sustain, and I know of so many cases of, owners and tenants having to go back to the negotiating table. And even, a very recent example was actually a multinational in FMCG, and they wanted to renegotiate their lease and opt out of a USD-based rental. So I think it's easy to have it on paper, but it's much more difficult to operationalize and sustain. I think it's easy to do it in the earlier years, but then it becomes very expensive for a good number of tenants. It works well for multinationals, in grade A buildings, for, their strong covenants, they have global operations. It's much easier that way, but when you localize it and you have a lot more local and national tenants, I think it becomes a bit harder to sustain. Yeah, that would be my thinking. Yeah.
Quaground dollar does not work. That's what. Yeah? No, like legit. Okay, please introduce yourself and pose your question.
Okay. Good afternoon. My name is Pauline Mugera. I work for GCR Ratings. Thank you so much for a very engaging session. My question is on the role of credit ratings. What do you think would be its role in de-risking some of the risks that investors are kind of like shying away, in order so that you can be able to boost, and REITs will be able to boost it so that we can move from just having the conversation to now having investors now really investing in these REITs. Thank you.
Mary, do you want to try that?
Yeah, I think that's a good question, and I think credit ratings would be useful if, of course, it depends on the REIT structure, and if, because typically if it's a REIT structure with an equity, an equity focus, then of course the need for a credit rating may not be that pronounced. Because I guess the point then is to give comfort to the investors around the credit quality of the issuer. But if of course the REIT itself is structured as an equity instrument, which is the case in various markets, then maybe there is no immediate need for that, is what I'd say immediately. But I know that there are some structures that encompass a kind of debt element. But beyond that, what I'd say, even beyond the discussion that we're having around REITs, the issuer can be issuing REITs, but may have other instruments that they are issuing, debt instruments, that may require them to have that credit rating, which actually demonstrates to investors that they are creditworthy. So the way I look at it is REITs is just one instrument in a pool of many tools that can be used, capital market instruments that can be used, and they can be used together. And so I would say that if the issuer is issuing debt, then it definitely makes sense for them to get a credit rating. I think, at least what I see is that, of course, investors would be more comfortable, and I know there are those in different markets who can speak to that in terms of what it means for the investor in terms of investor appetite. Yeah.
Maybe I think we have a practical case in the market where I think the rate was credit rated, and I think Econ went for that. And I think it was a big win for Econ in the sense that they were able to attract especially foreign investors, because there are certain matrices which foreign investors look at, and one of the things is really the credibility of the rate which you are bringing into the market, and then that becomes a very strong point when your rate is rated. And of course, as she says, it applies more when there's an element of debt mixed in the equity, in the rate arrangement.
I am loving that question, because this is year 2 of this conference, and Lord knows I'm not getting any younger. So year 3, can I ask the VIP table, seeing as I'm here as trouble starter, this issue of stamp duty, right? You said we're almost there. Why don't you, right, Chatham House rules, why don't you cough when I get to the time frame that is actually almost? Okay, ready. So is almost 6 months, within 6 months, okay? We've all had our Strepsils, fine. Is almost within 1 year. Oh, Lord. Year 3, RAK. We're back at Enashipai. Is almost... Jeffrey, you know, yeah. Okay. Is almost 2 years. Come on. Just coughing. We're just coughing. Is almost within 2 years. Is almost within 3 years. I said 1 year and you didn't cough.
No, we did.
Oh, you coughed. Did you actually? Did they cough? So within 1 year, so that means next year we're having a massive, massive party because it will have been done.
Yes.
You heard it here first, folks. Agnes, come, let's start. Agnes is my soul sister in causing. Go.
Yeah, I'm Agnes. My question goes to Mary. She talked about impact funds. So I would like to know, very few features of that impact fund. Who are the investors in the fund? Is it a product that is approved by the central bank? Are the treatment, if at all being managed by banks, does it have conflicting products that at the end of the day is destroying the shareholders of the banks? Who are the people to manage it? Because I see as well audit firm managing such. So that is the thing. Yeah, thank you.
Okay, thank you. That's a good question. So maybe let me just collate a bit to say that. So when I was talking about institutional investors, the impact funds may be varied. There are very many. They could be foreign funds. They could be actually funds with a mandate to invest in Africa. Like I can give an example particularly of one that we are investing in together with other DFIs called the Africa Local Currency Bond Fund. So all it invests in is in local currency bond issuances in this particular case. I'm just using this as an example, but this is an example of such a fund. Bond issuances on the continent, so local currency issuances of innovative first-time issuers of local currency bonds. So, I mean, like for example, that fund, and I'm using it as an example, it is seeded by different DFIs, so they have provided capital, and the mandate for that fund, for example, is to invest in impactful, so it may be social, green, whatever, impact. Basically, one of the objectives is impact, but another big objective is capital market development, so providing anchor investment for some of these innovative instruments when they come to market for the first time in new markets. So what that does is it catalyzes other investors. Like for example, if you hear IFC, for example, has anchor invested in an instrument, then of course other investors also invest. But that's one example. There are many other funds that have a focus on impact investing within the region. We are also finding that development banks, some large development banks, even sovereign wealth funds, now have in different countries, now are looking to put a portfolio of their money in sustainable instruments or impactful, with impactful outcomes. So basically, I think the term funds is a generic one. I don't necessarily mean the ones that are, it could be some that may be registered by a regulator in a particular country. Like I can give an example. I think there is one that I know of. I mean, there are several, of course, in Africa, but I have in mind one that invests in Nigeria. It's a Nigerian fund. It's registered by the Securities and Exchange Commission there to invest in infrastructure, and it does climate resilient and just basically looking at beyond return also what other social sustainability outcomes is the project achieving. So I think in brief, just to say, there could be many offshore, onshore, or offshore that have an objective to invest onshore. So I didn't quite have in mind, or when I was speaking, I didn't quite have in mind the ones that are actually licensed, similar to collective investment schemes, if I get you right, because I think when you're asking about the different the different players, and but maybe I can take it up with you after this. I don't know if I've answered your question.
I think I think, can I please request, can I book you and you lunch? You two sit together and eat potatoes and discuss. Because Agnes, we love Agnes. We've got our lucky last question over here, Mr. Havelock.
Yeah, hi. Anthony Havelock is my name. Shadrack, question for you, if you don't mind. An age-old question and a frustrating one, particularly as an agency broking-orientated type individual. When are we going to see a shift in how valuers approach yield shift? You talked in your panel very well about family and the private sector having high expectations of their assets, 7-8% yields. When might we see some yield shift in the institutional market from what are traditional yields held for a huge proportion of real estate assets to potentially get a bit of liquidity in the market and possibly even a rebase of the whole sector, which will then allow for some excitement and for real estate to be able to compete against government bonds and certain other asset classes which everyone else is so favorable about?
Right, I think Joanne sitting next to you might want to help me with that, but yeah, I mean, look, Anthony, it's a real problem in the market. I mean, it's a proper hindrance to transactions happening in the market. And I think the biggest problem, of course, is that the more our market gets institutionalized, the better transactional data we have, and the better we have a better base of transactions to base our arguments around transactional yields, right? Because if you look at mature markets in Africa, like South Africa, I mean, you have the REITs dominate the commercial real estate market. So there's no argument around where are yields going. I mean, what are we transacting at? Because there'll be a REIT acquiring some assets from another REIT or from a group of individual investors, and there's transactional evidence that everybody can look at and say, this is what the market says. But in a market like Kenya, where the bulk of the ownership of the investment grade assets is in private hands and family offices and whatnot, then there's a lot of sort of I think it's a lot of sentimental value attached to some of these properties. So I think the solution to that really is, number one, more institutional players in the market, so that there's more transactions happening in the market that are out there, and we can all have a consensus around, for a grade A office building, whatever, strong well and whatever strong covenants and dollar rentals and whatnot. This is sort of what we think investors would be willing to accept as a return. But I think also from back to now as an industry player churning out, these advisories to clients, it's also upon us, of course, to try and make better arguments, even in the absence of recent transactional data. Yeah, because we have to sort of have regard to really the whole investment market, the whole capital markets, where are returns? Because I mean, look, if as an owner, Matthew, for instance, you have an acre of land in Upper Hill, and you want 600 million for it, and we all agree that in the market that land in Upper Hill is worth 600 million Kenyan shillings, which is about what, couple $1 million. What's that? Yeah, $4 or $5 million or whatever. And then you have gotten 3 offers for the property between 400 and 450. There's no justifiable reason to keep arguing that this property is worth 600 million, because we have offers on the table. We have not transactional evidence, but evidence from potential purchasers who are willing to offer within a certain range. But the peculiar thing about the Kenyan market, and it's not a Kenyan problem, this is where I say Africa is a country, because it's something I see in other markets as well. Accra has some areas with ridiculously very expensive land. So it's a function of really, there's evidence on the table from potential buyers, but the sellers really are not motivated to sell. So I don't see how else to motivate them to sell other than the market getting more transactions, and then more transactions happening, and then there's more institutional players, so there's more evidence of transactions in the market. Yeah, but as long as there's a lot of individuals holding property and being very sentimental about it, then that problem will persist. I hope I've answered your question.
Perfect. Thank you. Good effort. Yes, we're into the meat of things. Gloves are off. Questions are good. Agnes, Mary, please, I know you're on short time, so you can meet a little bit later. Thank you very much. A round of applause for our esteemed panel, please.